Are you curious about which ETF is the best for dividend growth in 2025? Today, we'll compare SCHG, QQQM, and VUG, three of the most popular growth ETFs on the market. SCHG, also known as the Schwab US Large Cap Growth ETF, boasts a low expense ratio of just 0.04%, making it one of the cheapest options for investors seeking growth and diversification. Meanwhile, QQQM, a lower cost version of the well-known QQQ, comes in with an expense ratio of 0.15%, but offers historical dividend growth that is hard to beat. VUG, which focuses on large cap growth companies, also has an expense ratio of 0.04%, putting it on par with SCHG when it comes to cost. Let's talk about growth first. SCHG has delivered an impressive compound annual growth rate, or CAGR, of 13.3% with a long-term total return potential of 13.9%. It holds around 250 companies, including big names like Alphabet, Meta, and Tesla, making it a highly diversified option for growth-focused investors. On the other hand, QQQM tracks the Nasdaq 100 and has shown a slightly lower growth projection of 11.8%. But its historical total return has been outstanding, with QQQM ranking in the top 2% of all large cap growth ETFs over the past 12 years. VUG, which tracks the CRSP US Large Cap Growth Index, has also shown growth with a long-term CAGR of around 12.6%. Now let's focus on dividends, where QQQM really shines with an annual dividend growth of 17.1% since 2005. QQQM is the king of fast dividend growth ETFs. This beat both SCHG and VUG by a significant margin. SCHG's dividend yield is around 0.5%, but it has experienced several years of negative dividend growth, including an expected decline of -8% in 2024. Meanwhile, QQQM's dividend yield sits at 0.8% with only one negative year of dividend growth in the past 17 years, making it the most reliable for income-focused investors. VUG, on the other hand, offers a lower dividend yield at around 0.6%, and its focus on capital appreciation means dividends aren't as much of a priority. In terms of risk, SCHG and QQQM have similar profiles, but VUG has a slightly higher volatility due to its focus on large cap growth stocks, which tends to fluctuate more during market swings. SCHG's portfolio is more diversified with over 250 companies, while QQQM is more concentrated, holding just 100 of the largest Nasdaq-listed firms. This concentration makes QQQM a bit riskier, but also more powerful when it comes to delivering consistent returns. When we compare historical performance, QQQM stands out. It has consistently outperformed SCHG and VUG over the past decade. Since 2010, QQQM has delivered average annual return of 16.8% compared to SCHG's 13.5% and VUG's 12.6%. In fact, QQQM is in the top 1% of all large cap growth ETFs that have been around for at least 15 years. Thanks to its focus on high growth tech stocks like Apple, Microsoft, and Nvidia. In terms of valuation, SCHG's price to earnings, or PE ratio, is currently around 21.5, which might seem high, but its price to cash flow ratio is more reasonable, 13.9. QQQM's cash adjusted PE is even lower at 13.5, making it slightly more attractive from a valuation standpoint. VUG's PE ratio sits around 22, reflecting its focus on high growth companies, but it's still within a reasonable range for investors seeking capital appreciation. If you're focused on dividends, QQQM clearly wins with its dependable growth and solid performance in both good times and bad. During the Great Recession, QQQM still managed to grow its dividend by 17%, and during the pandemic, its dividend growth remained positive at 9%. SCHG's dividend growth, however, has been more inconsistent, and VUG, while focused on growth, doesn't offer the same dividend dependability. What about cost? SCHG and VUG have a lowest expense ratios at 0.04%, but QQQM's 0.15% fee has historically been worth the cost given its performance. SCHG, with its focus on a broader range of companies, is a great choice for diversification, while QQQM's concentration in the top 100 NASDAQ companies has led to stronger returns and more dependable income growth. For those who prefer broad diversification, SCHG's 250 company portfolio might be more appealing, offering exposure to various sectors like technology, consumer discretionary, and communication services. However, QQQM's more focused approach on tech giants has paid off with stronger growth and dividends. VUG, while a solid performer, doesn't offer the same level of dividend growth or reliability, making it more suited for investors seeking capital gains. Ultimately, each of these ETFs has its strengths. SCHG offers the lowest cost and the broadest diversification, making it a solid choice for growth-focused investors who want exposure to a wide range of companies. QQQM, with its unbeatable dividend growth and consistent performance, is the best option for those seeking both growth and reliable income. VUG, while strong in growth, falls somewhere in between, offering decent performance but not standing out as much in either dividends or long-term total returns. If you are looking to build a balanced portfolio in 2025, combining SCHG and QQQM could provide you with both growth and income, while VUG could serve as a complementary holding for those focused more on capital appreciation. Ultimately, the choice between SCHG, QQQM, and VUG depends on your investment goals. But if dividend growth is the priority, QQQM remains the king.